Brother Faz, very nice to see you today. How are you?
I'm very well, thank you very much, Stephen. And yourself?
Yeah, very well. I can't complain. Can't complain at all.
Amazing.
First podcast. How do you feel?
I'll say a little bit anxious. With that being said, I feel like we have a lot of information to give. We've got a lot of value to add to the general public and people that are looking to invest in the UK and just property in general, really.
I think that's a great phrase, value to add. Yeah, that's why I like to do with a lot of my clients, and hopefully this is what we're going to do today. I think that being said, and this being the first official podcast, it would only be right for us to introduce ourselves. Would you like to go first?
Why not? Yeah, so born and raised in London, have been in the property market, I would say, for about 8-10 years. Actually in this role, just over 2.5-3 years. And the reason why I actually got into it, helping people scale and start investing in the UK and also internationally, is going back to what I said originally, adding value. A lot of people want to get into the property market, and it's not something that should be done without the expert advice. So yeah, educated myself in the property market, and that's about it really.
Helping others now.
Exactly.
Yeah,
yes.
I'd love to see it. So myself, as you know, or as you don't know, my name is Steven. Also born and raised in London, an area of South London, Battersea, very close to Chelsea. Been in and around property now for, like yourself, about a decade. However, in terms of this role, been doing it just over 3.5 years. Was very fortunate to be working in an office in Berkeley Square in Mayfair, where I kind of learnt the trade, learnt the industry. From there, went on to manage that office, and then had the opportunity to move out to Dubai. From there, actually went back to the UK for a bit, and then came back out to Dubai. So now I feel like I've had a lot of experience in the industry. I've seen a lot of things, seen different projects, worked with different developers, worked with clients in 28 different countries. Very proud of that, very proud of building portfolios and helping clients grow. A budding investor myself, have a small portfolio that I'm proud of and looking to build. It's why I'm able to co-sign and really see it from the other side when I talk to my investors. I think that's a good run through.
Yeah, well, thank you very much for that. Going on, you've been in both markets. I know you've also invested in both markets. What would you say is, we've lived in Dubai for a numerous amount of years now, and a lot of people say we're in a market that's doing phenomenal growth. The money's to be made here. Why the UK?
It's a great question. It's a frequently asked such question, actually, from a lot of clients. And I'm going to go with the main word, which I think is stability. And then back that up with security as well. Stability and security. Over the last 70 years, we've seen the property industry in the UK grow by 365%. That's inclusive of inflation as well.
Wow.
And with a market like that, the UK pretty much writ the law on kind of property as well. So it's evidenced that over time this has worked. And we've seen it ourselves. We live in the UK. My parents are both immigrants. My mum's from Malaysia, my dad's from Nigeria. Both of them moved over and created a great life for myself over in the UK, which I'm really, really proud of. And for them at that time, in terms of their roles that they were in, they had the opportunity to buy a house. If we now look at our generation rent, how hard is it for us to buy a house?
Yeah.
And I think we do need to touch on the subject, because a lot of people do kind of skirt around it. Socially, it's an awkward subject because we want everyone to be housed. But in the UK, there is a chronic undersupply of rental properties. However, if you look at that on the investor side, that is fantastic, because it simply means that with supply and demand, if something is undersupplied, there is more demand for it. So prices are going up. Rental demand is huge. I think there was a BBC report back in last year, July. It said for every one property in the UK, there are 20 people looking to rent that one property. It was topped out in 2 regions. One was the West Midlands, so areas like Birmingham, Coventry, Wolverhampton, etc. And then the top of the country, worst kept secret in property investment, as you know, is the Northwest, Manchester. a city close to my heart, United, FA Cup win. Come on, boys.
Unfortunately.
Come on, boys.
Bad taste.
But that also feeds into the city. And to go back to your initial question, why the UK? It's that chronic undersupply. The chronic undersupply, it's a stability, it's a security. It's to know that in time that this is going to grow. And we're going to put that kind of juxtapose that to Dubai. As Dubai's been around for 20 years. 20 years ago, there wasn't much built here. And property, like anything, goes through cycles. Dubai usually goes through a 7-year cycle. So you had the initial 7 years where things were built. It was a bit of a cowboy city because you could purchase property and there was no DLD. There was no kind of regulation around it. So I could sell you a property, Feisal, and you could say, oh, I'm going to add 100 grand onto that property and send it on to the next person. And that was happening in buildings. So therefore, price around property used to fluctuate. So if a developer sold me a house that's actually worth 100 grand, you sold it for 200 grand. If we actually come to value it, you might have one property in the same building that's 100 grand and someone might have bought it for 300 grand. So you can see where that was a mess. Second cycle was, of course, Dubai has really invested in the expat market. It's built majority of expats, but a lot of those expats went home and they didn't actually live in Dubai. So that, in terms of the property market, was a bit of a problem. Now what we've seen is expats staying in Dubai. This was evidenced during COVID. A lot of people chose to stay in Dubai. However, my point is, and I think I've gone, as I always do, around the houses to say it, is there's not that much history. There's not that much history to evidence it. And I think the volatility here, if you're a risk-averse person, if you're just coming into the market, if you're looking to just build a portfolio, the UK offers that, as I bring it around the houses, stability and security. And I think that's really important.
Okay. Well, yeah, that was a lot of information. So from what I gathered from your answer was, you're looking for long-term, you're looking for stability. The UK is a place. But then, I've got many investors that make the 12-15% in Dubai. So for ROI and short term, would you say Dubai and UK is more of a long-term investment?
It's really dependent on your situation. Like what we do is tailor all of our consultations towards what our clients looking to do.
Correct.
To answer your question directly is, yes, you can make more money quicker in Dubai. But quick money is not always the best money.
Yeah.
You know what I mean? Like what we're talking about here, property is something generational. It's something that you want to be able to pass on to your kids. And to do that, sometimes, there is a big misconception in property, I think anyway, especially in buy-to-let property, that rental income is the main driver. I would argue with anyone that capital growth is. That you're looking for equity in your property. It's really how you make that word generational wealth. And the UK, in terms of how the structure is in property, where you can really leverage your cash, you can put 25% of the purchase price down. Of course, we'll go into more detail about that, and then leverage the rest. And you can then draw down on that equity after a 5-year term and reinvest that money and use that to snowball your portfolio without having to invest hand over fist. You're essentially organically letting your seed capital, the money that you've initially invested, snowball and grow your portfolio, which is fantastic. And to come back to your initial question about kind of UK versus Dubai and in terms of direct income, we always have the option of serviced accommodation.
Yeah.
It's something that you can do. Service accommodation, for the people that don't know, would be Airbnb, Booking.com, etc. It's a huge market. I think it's over 50% of the UK have or stay in the UK as a holiday. I know when I go up to Manchester, I like to book an apartment. A nice little 2-bed apartment in the city centre where I can go, and especially if you're doing it with the lads, let's say we booked a 2-bed, what's £80, £100 between the two of us to, I don't know, if I go watch Man United, go watch the fight, go watch AJ, whoever it is. So that's a huge market. And then also you have the staycation market in the UK, which is booming. You have places like, for ourselves, we work with Live Retreats, absolutely fantastic product, where an investor could come in, pay cash, and just get 10% net passive returns and do nothing. They're not paying any overheads for, they're not paying any management costs. So definitely, I think, yes, you can earn more money through a higher rate in Dubai, but we can also do that in the UK, and there's ways to do that.
Okay. And another question that I have from a lot of my investors is tax, right? A lot of the people run away from the UK, run away from the Western countries, and come here for two things really: money and the sun, right? Unfortunately, the sun's not something that we have quite often in the UK, and even if it does, we have chances of rain in 2-3 hours.
Yeah, 100%.
But second to that, when you really start earning some good money in the UK, especially being an employee, you're going to have to pay quite substantial tax, whether that is being an employee or whether that is an investor. So how would you answer that question in terms of tax, whether it is somebody looking to invest just starting, or whether it's somebody that's looking to start a portfolio? Why would they once again invest in the UK, where there is so many different taxes, and in comparison to Dubai, where there's no income tax, there's no capital gains tax, and the money's all theirs?
Well, the dreaded T words. The two things that were promised, death and taxes. Taxes, let me see. Taxes are unavoidable in the UK. There's no way of kind of not stating that, and I think it goes for a good cause. We go back to socially and what that does and what that enables you. We've grown up in the UK. We've had the NHS. We've used the NHS.
Probably the biggest blessing in the UK.
100%.
And schooling.
Kneel for our doctors, because they really do deserve it.
Agreed,
I would also say give them a pay rise, not just kneeling.
Well deserved.
But I've used them at NHS many a time for many things. And taxes are necessary, first of all, so let's get that kind of clear. But there are ways to mitigate taxes, and there are avenues to do that. So, for example, you asked, why would someone invest over in the UK? I think we answered that question earlier. Stability and security. That's the main reason. It's going to give you good growth long term, and it's generational. In terms of taxes, so there are things you can do around owning a limited company and purchasing property under a limited company structure. And to do that, what it allows you to do is to pay something called corporation tax. Corporation tax is if you were a higher taxpayer, someone that was earning or being taxed 40%, etc. If you pay corporation tax, it's almost half of that. It is half of that. It's 19%. Okay. Yeah, which is fantastic.
On any amounts?
So it's not even on any amount. How tax works is you're not taxed on the full amount. So you have your tax for up to a certain amount, and then the amount over would be taxed at 40%. You know this, right?
Of course.
Yeah. So in that you're paying corporation tax, first of all, depending on the country that you work with, there is a treaty with the UK that the first £12,570 is tax-free. Yeah. So for ourselves that are not living and working in the UK, if you just have one property, essentially you're not even majority getting taxed on that property.
Yeah.
And then if you go over that bracket and you have the corporation tax, over that bracket, that 12,500, you would only be taxed 19% on the amount over that. So if you was earning £1,000 over that bracket, you're not taxed on the whole 13,000. You're taxed on the £1,000. Yeah. So you would get 800 of that. Yeah. Well, that's 19%. So maybe a little bit more. There are also many other factors kind of in and around that limited company structure. So it's called something called an SPV. It's a special purpose vehicle. So what that does is also helps you in terms of your liability, because what you can do is put each property within a limited company structure. So it ring fences you from anything that was to go on in your portfolio. Also as well, it helps in terms of your estate planning for future planning. I talked about property being generational. We want to pass this on to the next generation. The minute your kids, your sister, your mum, even whoever it is, they just need to be 18 years old, and you can have them under limited company structure. What you can also do is put yourself as a director. So you can put yourself as a director, own 1% of the company. They can own 99% of the company. Inheritance tax in the UK is 40%.
Above a certain bracket, right?
No. Inheritance tax.
Inheritance tax.
Sorry,
not capital gains, correct.
So inheritance tax is 40%. That's for everyone. However, if you only own 1% of the property, at that point, you're only taxed on that 1% of the property. So you've circumvented the inheritance tax there.
And just to follow, so is that anybody that can be also a shareholder in the property company?
Yeah, it's pretty much if you're over 18 years old.
Over 18.
Yeah, if you're over 18 years old, you can have that. And anyone in the world can be that. You need to be a UK resident or anything of that ilk.
Understood.
So yeah, to answer your question, there are ways around it. There are a lot smarter people than me, and the good thing about us is we have over 700 partners globally.
Yeah.
That's mortgage brokers, that's buy-to-let specialist mortgage brokers for people in different countries. That is companies that set up and run limited companies for you, so totally passive, totally hands-off. Accountants, and I'm not a tax specialist by any stretch of the imagination. So I always say, do not take tax advice from me. This is not tax advice. This is not legal advice. This is just through my own knowledge and of course and experience. Thank you. But we can put you in touch with people that are and definitely help you out in that fact if that's what you're looking to do.
Okay. So kind of just as a synopsis, what you're saying is if you're a small-time investor, you have one property and living in Dubai, you've got the only tax you'll be paying is after 12,570, 20% on that. So if it's one property, you're making about 15k. Of that 2.5 remainder left, you pay 20% of that, which is near to nothing. Should you want to scale a portfolio, then we have somewhat, we can say, loopholes to mitigate risk, tax, and also inheritance tax. Am I correct?
100%. People ask about council tax as well. Council tax is paid by the tenant.
Yeah, correct. So, okay. So tax answers, you answered the question. Now, you also did touch on the seed capital, all right? What you said is somebody that's planning to invest in the UK and grow a portfolio, what you'd advise is buy-to-let investment, mortgage, which would be 25% down payment. The remainder is mortgaged, and then after a couple of years, remortgage the property, take that seed capital out, and carry on the expanding the property portfolio by purchasing more properties.
Exactly that. Faiz, you know me, I'm a numbers man.
Correct.
We are very data centric. We research macroeconomics, wider economics, and then take a fine tooth comb to the microeconomics. It's really how we add value, as you said earlier. And let me give this example. For easy maths, you buy a property, that property is £100,000. You put 25% in, which is 25k. You get a mortgage, loan to value. So loan to value is the loan to the value of the property that you take in, which is 100,000 of 75k. After 5 years, that property grows by 10k each year. For this example, I'm not going to compound it. I'm just going to say 10k. So after 5 years, now that property is 150,000. You refinance on that property if you took an interest-only mortgage. So you're only paying the interest. Why we do that? To stay more liquid. So you owe the bank the same amount than what you initially took out. You owe the bank £75,000. But now the new value that you can refinance on, 150,000, is 112,500. The difference between the two numbers there is 37,500. You can take that money out tax-free and do with it as you wish. Like a lot of people here in Dubai, you could go to Marbella for the summer, you can go to Thailand, or what the savvy investors do and what we advise our clients to do is reinvest that cash. And you notice that I haven't even talked about rental income here. If we just, let's say, call rental income net £500 a month across the year, that's 6k for the year. Across 5 years, that's 30k. You add that in to what you've just got at the 37,000.
67k.
67,500. That's another property. That's a one bed in Birmingham. You want to top that up a little bit, you can go for a 2-bed in Manchester. Well, as Manchester prices are gone, I don't know if it's going to be that in 5 years that you can, but you can see how that works, and you can see how you can then snowball and grow this portfolio by using your seed capital.
Okay. Thank you very much for explaining that. So delving a little bit deeper into mortgages and getting into the property market, of course, being in the Middle East, and also being a Muslim myself, a lot of people are, of course, against the mortgage. But the people that are not, can you give a little bit of insight on mortgaging, and are people that are not residents of the UK able to get mortgaging, and how it would really work?
Okay, great question. I don't want to say anyone because it's not anyone, but working clients in 28 different countries now, majority of my clients, I would say well over 90% can get mortgages. Again, there's some treaties with the UK, etc. But mortgaging, especially buy-to-let mortgaging, we have buy-to-let specialist mortgage providers and lenders. We have the open market that we can get on. And in terms of how the UK is going, as we've seen with all what economists are saying, inflation has come down now over the last 11 years from 8.7% last year June to this April being 2.3%. The government has tasked it with being 2%. Why am I saying this? It means interest rates are coming down. So for everyone looking to get a mortgage, that was a great time to be in the market. I wouldn't say now more so, I'd say get something off plan maybe in a year's time, 2 years time, where it really does cool down. We work with a lot of clients in Kuwait, for example. Kuwait National Bank give mortgages. And so from what I've heard from my clients, some of the rates are even better than what people are achieving in the UK.
Yep, agree.
So yes, people can get mortgages. Some of the countries to name, I've got clients from Nigeria, my home country, Malaysia, Kuwait, Saudi, Bahrain, Qatar is a main one, South America. So I've got clients, Venezuela, Colombia, USA, Ghana, Europe, all over Europe, Italy, Spain. They've all got mortgaging.
Just because also another question I always get asked is, as the bank, why would the bank give them money to purchase property that they cannot see that they're actually making money, right? So if you're not working in the UK and you can show pay slips, if you're working anywhere in the world, you can make up pay slips and send it through. There's no real backtrack for this. So why is the bank still giving loans to people that are buy-to-let investors?
Banks are businesses. Banks are businesses, simple as. We had the financial crash back in 2008 where we had these toxic mortgages. That's what kind of crashed it. Banks were given 100% mortgages. So you didn't even have to put any money down, which why we happened. So banks are much more stringent when they look at people. However, with a buy-to-let mortgage, what's really focused on is, does the property wash its face? And what I mean by that is the rental income of the property, is that enough to cover the mortgage?
Okay.
And at that point, all they need to really understand is if there were potentially any void periods, if there were any periods that this property was not, didn't have an occupant in, can you cover the cost of the mortgage? And that bit is looked at. So where buy-to-let mortgages differ from kind of your own personal mortgage, a personal mortgage is simply, do you have the money to pay that mortgage? Whereas the buy-to-let mortgage, you more look at the property than you're looking at the person. So I think that's why banks are more inclined to do it. And of course, why do banks do it? Banks want money. Banks are businesses.
So from what I gather from what you said is, the banks are seeing it as a business opportunity.
100%.
Right? They're shareholders in that business. They see where that business is at. It's a good property, good developer, great location. They can see the rental yields in that property. So for the property being able to pay back its dividends to the shareholder, being the bank, very, very easy to do so.
100%.
Amazing.
You lend me 75 grand. And I pay you 5% for the next 5 years. And I still owe you the 75 grand. Would you not be happy?
Of course I would.
There you
It's
go.
a great investment.
There you go.
75 grand tomorrow for you.
You'd be lucky.
Okay. Moving forward, so I like to go through 3 scenarios, right? These 3 scenarios are, I would say, the most common scenarios that I come across with my clients, right? So if you can give me, I'll give you the scenarios, and you can give me just what you'd advise these
Perfect.
3 scenarios. As you said, we like to tailor our investment properties to the client's goals. So scenario one would be, I want cash. I need cash flow. This cash flow is for my retirement. I've got 200k cash. I'm not looking for a mortgage, but I want high returns. All right.
Okay.
I have also invested in other countries such as Dubai, Cyprus, and Italy.
Yeah.
The 2 properties that I have in Italy and Cyprus are all short-term rentals, and the Dubai is a long-term.
Okay.
What would you advise me?
First of all, congratulations. You're a big baller.
Thank you very much.
200 grand just to fly. You've got a really good portfolio already. That's an easy one for me. I would say go for the lodges.
Okay.
Go for the lodges. You go into retirement, you want something hands-off, you want something passive. The retreat. So with the lodges, the concept around it is pretty simple. You get the holiday lodges. We have 6 locations across the UK. 16, sorry. 16 locations across the UK, of which I stayed actually at one back in January, and it was freezing cold, but the park was, I would say, 75% filled.
Amazing.
On a weekday. And I had a fantastic stay. Like, each of the lodges have their very own hot tub. It's just very serene, it's peaceful. Like, we're both city boys, we've grown up in London. Sometimes it's good to just have a break, hear birds, see stars, reset. So it's fantastic investment on that side. And in terms of how it works is you essentially pay the cash. So the lodges start at 140,000. There are lodges that go up to 200k, and you get to an 8 to 10% return on these lodges, which is paid to you quarterly, totally managed by the management company. You don't pay any stamp duty, and it's very vanilla. And then even with that,
so stamp duty, what's stamp duty exactly then in comparison to Dubai?
Yeah, so stamp duty is what you call in the UK, in Dubai it's called DLD.
Correct, land tax.
Land tax, and it's just land tax. At any point in the UK, the government are going to put their hand in your pocket and try and take some cash.
Of course.
But this doesn't count exactly as a quote-unquote residential property. It's kind of falls under a different hat. So with that, you don't have to pay stamp duty on the property.
Okay.
There's no management cost of the property, and you get quarterly returns. And the best thing is, you're going to ask me, or the clients ask me, Steven, what's the exit route here? It gets bought back off you. There are buyouts, and these buyouts can happen 3, 5, 10, 7 years from purchasing the property, and it's an uplift profit as well.
So who's buying it back off you?
So the Live Retreats are buying it back off you.
Okay.
How it works, and why is it people say, Steven, this is too good to be true? No, it isn't. The truth is, to be very transparent, they're offering an 8 to 10% return because they are making 12 to 16%. It has to work for them also. They have to have a margin. And by having that margin, what they're trying to do is, we said 16 parks, they want to scale upwards. And by having investors come in and purchase the lodges, it allows them to accelerate that process. And on the lodges themselves, it's not just you go to the holiday lodges. You have the one that I went to had an alpaca farm. Beautiful. Like my sister and the family were over there, and I got countless videos of them having a great time, and my nephew absolutely loved the alpaca farm. Also, in terms of, you can have weddings there. It was built on a fishing lake. There's 5 lakes. There are things to do. There was Santa's Grotto back. I went in January. I saw kind of the remnants of that. There are 2 places you can eat. There's golf on site. The one over in Norwich is 20 minutes away from the coast. When it's not raining in the UK in the summer, it's absolutely lovely. It's a great place to be. And it's fantastic. So I think for all of those reasons, in that scenario, as that client that wanted something hands off and easy, then it will be a perfect investment. Feisal, where would you think Faisal, where do you think is the best place right now to invest in the UK?
Well, I would say Manchester. The reason being is if we look at the past 2 decades, Manchester has had the highest increase in pricing across the country. In terms of rental increase, we've had the highest rental increase across the country too. They've also got 2 of the largest football teams, 4 of the largest universities, 80% of Fortune 100 companies there. And I really do see Manchester being the next London.
Okay. And you touched on London there. Why should I invest in Manchester over London?
Well, number one would be entry level, right? London right now always will be a good investment purely down to demand, right? So if we're looking at the demand pool, London is amazing. If we're looking at ROIs or we're looking at capital appreciation, Manchester is far behind London. So the average entry level for London for a good 1-bedroom development, you're looking at around £350,000. If you're looking at Manchester, you're looking around £250,000. With ROI in London 4 to 5 and Manchester 6 to 8%. So clearly, the best buck for your money is definitely going to be Manchester.
Fantastic. As a buy-to-let investor that wants to invest in the UK, that wants passive income, but I want a high rental yield, what would you suggest is the best investment vehicle?
So we've actually got an investment commercial asset class, Live Lodges. This is a developer they worked with just under a decade, and they have holiday lodges that are completed and income producing across the country, starting price of £150,000 and give between an 8 to 10% annual yield. This is of course fantastic for an investor that is not looking for any hassle, as it's fully managed and hands-free investment, but secondly for high returns. So this is exactly what I would say for an investor.
Perfect.
So Stephen, being a British expat, why would you invest back in the UK?
Stability and security. It's the 2 best things about the UK. And also there are lots of people that come to Dubai that want to live a very flashy lifestyle, that go back home without any money. Secure your future, secure your children's future by investing in the UK. It's a stable market. There is a lot of history that we can evidence. And if you're a numbers man like me and that is data focused, the UK is the place to invest long term.
Excellent. So the 2 or the 3 biggest cities, London, Birmingham, Manchester. Birmingham being the closest to London. Please tell me why Birmingham is a great investment location.
Easy. I was going to say 3 letters, but one's actually a digit. So I'm going to go for HS2. HS2, High Speed Rail 2. If you're a Londoner, then you know about the Elizabeth line, the Crossrail that now spans west to east across London, and what's that done for property prices in commuter towns like your Readings, your Sloughs, your even all the way down to East London if you're Essex. And essentially HS2 is going to be Elizabeth line on steroids. It's a Crossrail that goes from Birmingham to London, and it's actually going to slash that time down of travel to 49 minutes, where it actually makes it feasible for you to commute from London to Birmingham to work. But what that's going to do for property prices is absolutely revolutionize it. On top of that, you have very large regeneration schemes such as your Smithfield's regeneration scheme. You've got an area of Birmingham that hasn't been as built up. If you look at the city on the west side, we've seen a lot of gentrification over the last 10 years. The Jewellery Quarter has been very built up. Walking through Birmingham earlier this year was like walking through a time machine. And honestly, that east side, that the area Digbeth, that is now going through that regeneration. The city centre, 25% of it is actually being built into Digbeth. So with that area regenerating, we see it as an emerging market, and it's a fantastic place to invest long term. You're going to definitely make a lot of money. And also, last bit actually, there are a lot of big build-to-rent companies, companies that are specifically, Aviva being one of them. They've just invested £400 million into the area that I spoke about, Digbeth. There are a lot of better brains than me, financial analysts that are going to work at Aviva that are looking at this area, and they're putting £400 million into it. It would give good indication that that's a good place to invest.
So when buying a property, Stephen, what are the key factors to consider?
Oh, what are the key factors to consider? Top one's timing. Timing, 100%. It's not the old adage, as they say, don't wait to buy a property and wait. And the reason that they say this is the longer that you take to buy this property's a moving target. As the kids say, yesterday's price is not today's price. And property is going to move on. And if you've invested in Manchester 5 years ago, as opposed to investing in Manchester now, you would have made a lot of money. And in the crypto hemisphere, there's another saying, as you can tell, I like my sayings, and it's buy the rumor, sell the news. If people are talking about it, the likeliness is that a lot of money has already been made there. You want to be early in, and the earlier you're in, the more growth that you're able to get. So I think top for me is definitely going to be timing.
Great. In terms of options, of course, we delved a little bit into locations, also touched up the lodges in Manchester. Off-plan projects, of course, are projects that are very, very prominent in Dubai and the Middle East. Are off-plan projects available in the UK, and why should you invest in an off-plan project?
Off-plan projects are available in the UK, and the reason that you should invest in off-plan projects, again, is timing. You're getting in below market value. You're getting in an area that has seen or is going to go through great regeneration, and you're getting in at the baseline price. It's again that word, that really key word, timing. If you can get something at a launch price, what developers tend to do, especially if they're building multiple blocks, and that's kind of what we're seeing the UK move towards, most developers increase prices 2-3% on each block. And if you're able to get into block 1 and it's 5 blocks, that's 15% in equity that you've earned in that building alone.
Instant capital appreciation.
Exactly, before it's even completed. So timing is key. Buying off-plan property allows you that timing, and also the way that you can structure the purchase. So what we've done for a lot of our clients, instead of paying 25% down, you can put 10% down, pay another 10% in 6 months, 5% on completion, and that way you can stay more liquid, which a lot of our clients want to do. And we have a very unique product for a developer that we work with, majority in Birmingham, not just Birmingham, they're based around the West Midlands, but they are bringing, or have brought, the first ever Dubai-esque payment plan to the UK. And what you need to do is you can put 5-6% down of the purchase price. I actually sold one of these properties recently to a good friend of mine. You put 6% down, let's just call the property 250k, that's 15k. And then you pay the rest of the 25-30%, whatever your deposit is, over the tenure of the build. So you pay £2,500 a month. And for someone that has a lot of disposable income, Feisal, let's go halves on one. Like it's a fantastic investment. So
very, very viable, especially for expats that are looking to get into the market.
1,000,000%.
Great.
Look, just before we go on, let me pose a question back to you. Why would you think buying off plan is a good investment?
Well, I'll say exactly as you said, timing is key, right? So if you're getting at, and especially in a location like the Manchester and the Birmingham with great regeneration, and you get in before the build, you're always going to get at least a minimum of 5% below market value. That is without taking into factor, as you said, if there are a few buildings, there's also going to be capital appreciation within the 5 buildings. Secondly, it will be the mortgage rates, right? If we're looking at mortgage rates right now are somewhat high. In order for us to mitigate that risk of higher mortgage, you put the 25 deposit in down now, you wait 2-3 years up until the property is ready, and should you want to resell, pay by cash or take a mortgage by then, you've already made some money on your property. So it's a perfect way to mitigate inflation and put your money where it's somewhere safe.
Fantastic. Feisal, there are lots of agents on the open market. Why work with us? Why work with Intermark Global?
Fantastic question. Well, first and foremost, we are privately owned, right? What I mean by that is we haven't got any ties with any developer, whether the UK, the UAE, Thailand, Turkey, and all the locations that we work with. So that means that for every investor that comes to us, we take their specific criteria and needs into factor, and we like to give them something that's tailored to them, right? Secondly, we are a full 360 company. What I mean by that is for your average investor that's looking to get into the market, we cover all areas, meaning finding the perfect property, solicitors, mortgaging, resale, property management, and anything in the ilk of property we can help you with.
Fantastic.
Amazing.
Not putting square pegs into round holes.
Exactly that.